Results out from Standard Bank this morning showed an 11% rise in headline earnings for the 6 months to June at the higher end of recent guidance given by the bank. Well, for more on those numbers, we're now crossing over to the CEO of the bank, Jacko Maree. Jacko, good afternoon.
Good afternoon, Stephen.
Jacko, would it be fair to say these are a mixed bag of results? Because while your impairment charges and credit loss ratios are well down from last year, your banking results itself has shown no improvement.
Absolutely. I think this is one of the toughest set of results I've had to talk to. When you look at the earnings decomposed and you take out the big turnaround that we had from Liberty, our life insurance and asset management subsidiary, the banking operations were actually down 10% on the comparable period. So a very tough period.
A lot has changed in the last 6 months, though, because 6 months ago, when most of the banks were reporting back for their full 2009 years, things were looking a little bit better, but the economy doesn't seem to have picked up at the pace we would expect it to have. How's it looking going forward from here, Jacko?
Well, I think if you read the general press, I think it is clear or becoming clearer that around the world the recovery seems to be slower and is going to take longer than I think all of us had probably hoped for, 6 months ago. So undoubtedly things are tougher out there, and it's not just in South Africa. Clearly, we are affected by what's happening on the African continent as well, and a lot of our African businesses have also been feeling the effects of the volatility in markets and so forth. So I think the rest of this year is going to be difficult, and we're probably looking to next year for sustained improvement. I think this is going to be a difficult year for banks.
How about beyond Africa? Because, of course, Standard Bank has the largest footprint in emerging markets from all of our banks. And headline earnings from outside of Africa down 64%. Of course, you've also been affected by a strong rand during the period. Costs are also up, and you're talking about costs going up in anticipation of a recovery. Is that something you're going to start seeing in some of the other emerging markets where you play?
Well, we I think today reported that in the last from a year ago, we've put in something like 750 new ATMs, mostly outside of South Africa on the continent. We've built some 60 new branches outside of South Africa on the continent. So we are investing because this is a long-term game, and it seems a shame to cut costs in the short term to protect profits and damage your long-term growth prospects. So we don't see this as a one-off change. We think this is going to be a gradual process, and that growth will return. Certainly, the investment that we're making both here and in other emerging markets, we think is justified that we should continue, because we strongly believe in our strategy and don't want to be diverted because of short-term problems.
Of course, you did talk in the commentary about a two-track recovery in the world, of course, the emerging markets versus the developed world, and you're quite strongly placed in those emerging markets. So do you think that you're going to see the fruits of this labour paying off in the shorter term?
We definitely believe that the fruits of the labour will pay off. The million-dollar question is when, and I think clearly for us, we are still growing and investing. It's not as if we have mature franchises in some of these countries. So therefore, we are in build mode and have been, and that has been fine while the revenue growth has been there. Of course, with revenue growth slowing down, which is essentially what's happened, it has exposed the challenges that we have, and the debate obviously then is, well, how do you embark on short-term cost cutting, or do you keep going? And our view is you keep going, because we think this is a temporary phenomenon.
Of course, one of the most exciting markets in Africa is Nigeria. Lots of the banks have been talking about perhaps benefiting from the shake-up in the Nigerian banking sector. How's Standard Bank itself positioning itself for mergers and acquisition activity, particularly through Stanbic IBTC Bank in Nigeria?
Well, it is common knowledge that we have registered our interest in the process that is being run by the Central Bank of Nigeria, which is to deal with a number of failed banks in that country. So we are looking at opportunities that may arise from some of those banks, and we have registered our interest. But when you are talking about acquiring banks that have essentially been in government curatorship for the last year or so, clearly there are many problems in structuring any kind of deal. So I don't think we should pin our hopes on that, but we are definitely continuing with that process. In the meanwhile, we continue to build our own branches and to hire people, and we are attracting more customers because our bank that we have there is sound and solid. So we're pursuing an organic strategy with a possibility, which is hard to quantify the likelihood of success of being able to do a deal of some sort. But the fallback position is that we just keep going organically.
You also talk about some of the resilience of your South African banking operations. Revenue down 4%. Overall loans and advances down by 1%. But interestingly enough, the mortgage advance is starting to look a little bit better. Would you see this as a lead indicator for the rest of your lending activities in South Africa?
Well, mortgages, we have seen the number of applications, I think we're up something like 77% from a year ago, and the number of registrations of new loans were up by more than 50%. So there definitely is more business that we're doing there. Some of that is because we have relaxed our own credit criteria, and are obviously actively looking for good business opportunities. But we did also acquire certain assets from a company called SA Home Loans, which perhaps flattered those figures somewhat. So at the moment, it's fair to say that lending growth is flat. There's not much net new lending. Of course, there's stuff rolling off and being replaced, but I think generally the loan growth is likely to remain fairly slow for this year.
You said you had relaxed some of your lending criteria. I mean, is there just really no appetite among South African consumers at this point to take you up on that?
No, I think the difficulty at the moment is that many people that would like to take out a loan from a bank want to do that because they are in trouble. And clearly, those are not the kind of customers that we're looking for. But at the lower end of the housing market, where people have got a solid income and can prove that their credit standing is good, we have made it slightly easier for them to get loans. But these things are set, and people either get through the gate or not. So I think it's probably indicative not of people not wanting more loans. It's indicative of people not getting over the thresholds that we've set, even though those thresholds are somewhat lower than they were a year ago.
Jacko, your Tier 1 capital adequacy ratio down just slightly to 11.8%. Are you comfortable with these levels, just given the more onerous requirements you're going to face going into the future under Basel III? Oh, definitely.
I think it is well known that South African banks are well capitalised. I think Tier 1 ratios of around about 12% would be the envy of many banks around the world. So yeah, I think we're well capitalised for whatever comes at us in terms of regulatory changes. The question will be over time, I suppose, where will these levels settle? And I would have thought that the Tier 1 levels will be in single digits, not double digits.